Okay, this is weekly commentary 14. I was recording, but this is my second take now because I was recording, but I was recording the wrong screen because I have a two monitor setup, right? So this is take two, yeah? So let's go to the weekly, it's not a big deal, let's do it again. So previous week commentary, right? What did we anticipate? I said that I want to see that this candle becomes a what? I want to see if this candle becomes a high. Now, how do we identify what a high is? Let's say we have three candles. It's a three candle formation, right? If this candle's high is higher than this candle's high and is also higher than the next candle's high, then this is a high, right? And a low is just the same, but with the lows, if this candle's low is lower than this one, the one before, and the one after, it's therefore a low. So using just that simple example of what a high and a low is, we can identify that this is now a high that is formed in the market on the weekly chart. So why is this important for us as traders? And I've taught you guys this. Why is it important that we wait for a high to be formed? Because what do we do with a swing low and a swing high? We can therefore then see the premium and the discount within the range, right? Now, if we do that, we see that if we go to the monthly, in the monthly, let me just move this. In the monthly, we have this fair value gap that we want to see rebalanced, right? Now, I'll show you how I have my internal dialogue with the bias. So I see that there's clear rejection, right? We've taken the previous month's high and we're rejecting down. And it's also taken significant liquidity above this high, right? And now there's a fair value gap that resides. So it's likely that the market wants to rebalance that. So if I carry this monthly fair value gap into the weekly, I see this again, right? So I just see another fair value gap within this monthly fair value gap. Now, I don't dare then go and draw this fair value gap out as well. I just see with my eyes and see that this is a fair value gap from this candle's high to this candle's low, all within this monthly fair value gap, right? Because there's another fair value gap here as well, and a small one that is from here to here. But what does the monthly do? The monthly acknowledges all of these fair value gaps. So let's just keep the monthly on. Now, if we take, right, around here is the 50% of this entire fair value gap. And I always consider 50% of the fair value gap. Now, when we go into the daily and we go from this high to this low, because essentially this is just the fair value gap. These two lines show the fair value gap bottom, fair value gap top, and this splits the range 50%, right? So let me go back and change this to, so now this is 50%. Now, what resides within the 50% of this fair value gap? This is a down close candle, and I taught you guys that as an order block. So within the monthly fair value gap, there's weekly fair value gaps. Now, if we take the 50% of the monthly fair value gap and we go into a daily, we see that there is a order block within this 50% of this entire monthly fair value gap. So where is it likely to trade to within that entire monthly fair value gap? Because we acknowledge the monthly fair value gap and that we're likely to trade into it, but where into it? The 50% is, a usual place that we like to trade into price arrays because it's a what? It's an algorithmic computation, the open and the 50. If you're going to code an algorithm to trade off of certain price levels, ranges of price, right? Because a fair value gap is a range of price, this range from the low to the high, and the 50% is the middle, and it's an easy computation to you know, compute into an algorithm. So we consider the 50%. And what can we then couple within the 50%? There's an order block on the daily that reinforces that idea to trade into the 50% of the fair value gap. Now, removing this and going back to the weekly chart, this is a low because this candle's low is higher and this candle's low is also higher. So this is the lowest low. We take this to the high. Now we have our dealing range. This is 50% of the dealing range on the weekly chart. So where can we expect the price to trade to? We can expect a rebalance of this fair value gap here to here. And it completely lines up with the 50% of the range. So I'm expecting the DXY to further roll over downwards, preferably into this fair value gap. And I want to see it trade to the 50% of the range. When it comes to 50% of the range, I'm going to then see any continuation to the upside, right? To, continue the trend. And let's build a further narrative on it because that's the technicals. Let's consider the macroeconomic background. It's May, right? June is going to start the next quarter. Now, what does the Fed, right? What does the Federal Reserve for America, what do they want to do with interest rates? They want to increase it. And they've actually said when they're looking to increase it. And they said in the month of June. So where are we now? We're in the last 10 days, right? We're in the last 10 days of May. And we're starting to trade lower, right? We're starting to rebalance the equilibrium of this price range. So let's build a narrative, yeah? We got this whole monthly fair value gap. We know they want to hike the rates in June, and June is also a quarter. So what's likely to happen? Are they just rebalancing this range and maybe possibly trading into a deeper discount so that when they hike the rates in June, we can then continue the trend? Seems likely to me, right? Think of what's going on with the, macro global context and then find it in the chart, right? They want to hike the rates in June. Okay, cool. We know what the hike in June is going to likely lead to in DXY. It's going to lead to higher prices because interest rate directly derives the value of the currency that we're looking for, which is a dollar right now. So increasing the interest rate for the dollar is going to increase the value that we see on the chart. So it makes sense before there's the big move for the big players, let's offer some sort of discount price, or let's at least go to the equilibrium of the range, right? So what are they doing in the last end of May? They're just offering that equilibrium of that range, preferably a discount of the range, before they can buy it up and take it higher, right? If we see Friday just rebalanced this candle's imbalance because before this candle we traded down lower and there was only sell side offered within this from this low to this candle's close. There was only sell side offered, and now we've paired that with buy side and it's likely to move down. What is the first liquidity pool that we can trade to? If we see this low, right? This low is the first liquidity pool that we can trade to. Is it more likely to take this high over this low? No, because look at the candles, right? The candles, what they're doing, they're big and they're aggressive to the downside. You see how there's clear intent to move down. You see these candles slowly moving upwards, right? And then we're moving down. And we have one candle up and then there's another candle that you can say quote unquote engulfs it, right? What are they reaching for? Are they reaching for this or are they keeping this intact? What is the first easiest person? What is the first who's sitting easily in the market, right? And this is what I do for intraday. Who's a sitting duck within the marketplace, right? Whose orders are ripe for the taking? Who can we easily take out of the market? Forget the time frame. What is the price telling you? Who are we reaching for? Who's the easiest person to get in line with to take their stops? These guys, right? We're close to them, right? We're very close to them, and there's a fair value gap to rebalance underneath them. So what do we do? Let's take their stops. Get in line and take their stops. That's how I view a lot of my buyers and a lot of my intraday targets. That's how I look to get in. I look to see who is the sitting duck for the market, right? Whose stops are easy for us to grab, and whose stops are we looking to grab, right? We're clearly moving downwards with intent. With the intent of what though? Likely to grab their stops. And then we can rebalance this trading ultimately to the 50%, which is the equilibrium of the range, rebalancing this price range. And then I'll look to find support within this fair value gap, within this monthly fair value gap, 50% of the range, or it could go to a deeper discount. But that's where I hunt. I don't just wait for the 50% and I'm in. I hunt. It's about preparation and anticipating, right? You look for the signs of reversal, see if these fair value gaps are getting treated as support. If we're trading through them, clearly there's no intent for higher prices. They're just disrespecting bullish price arrays, which shows what? Intent to go lower. Then they're probably trying to take out these guys here and these guys here. But for now, who is easier to trade to? Is it these guys under this low, these guys under this low, and this low, or this low? No, deal with what's in front of you first. And I say this all the time, a step at a time. These guys are first, right? I don't expect to get to these guys. I want to see this get rebalanced and move higher, right? So that's where I'm positioned right now for the DXY. I want to see further rebalancing of this. I want to see this low get removed and ultimately rebalance this area within the 50%. If we go to the DXY, I mean the Euro USD, my apologies, and we go to the weekly, we see that we have a fair value gap also, right? We have a fair value gap here on the weekly. So if we go to the daily, what do we have? Again, we have a short-term high and a fair value gap above of it, right? So we have a liquidity pool with a price array above it. Now let's add something to this. This is the high to the low of this range, right? Now you see before we had this move down, this was the range from that high to this this candle's low was a range, right? And we rebalance this area of the imbalance and then we move lower. Now when we move lower, what do? We took out external liquidity and we made a new price range to here now, right? So when we take out external liquidity, being this, because remember, this was our external range before. This low didn't occur. It was only up to here we had price. And then we made a new range. So we added to the external range. So now here to here is our external range. When we do that, when we take out external range, right, we want to see a move back into the internal range. Now let's build a narrative for the euro. We have the equilibrium that lines up with this buy side liquidity pool. And we have this weekly fair value gap here. This is the weekly fair value gap. Now, let me just add something to this Fibonacci. So this is the weekly fair value gap and its OTE range, right? Its OTE range. When we are using the OTE for our high time frame, it's not an entry technique, rather it's a reversal indicator. Because we know what happens at OTE. For when we are OTE on the lower time frames, it's an entry because we expect price to reverse there and we get in on the reversal. So for the OTE on the daily time frame, that's where we expect price to trade to, right? We don't just use the OTE by itself. We saw that OTE was within the framework of everything else, high to low, external taken out. We expect the internal to be traded into. Okay, we have a high that we are likely to take out. Look how close we're to the high. It's likely we're going to take that out. Above the high resides a weekly fair value gap. When we place the OTE from high to low, the OTE resides within the price array and it matches up with this run on this liquidity. It's a narrative, guys. It's a narrative. Okay. Now we trade into the OTE on the daily and we get rejection. What does that mean? When we get the rejection of the OTE on the daily, that means that our bias is in line with the rejection. Because when we reject on the daily, remember they're daily candles. So when we're rejecting daily and we're going down and down, well then what do? Intraday, we get in line with that daily optimal trade entry rejection and we hunt for short opportunities. Every short opportunity we get off the rejection of the OTE, We take that, and we take that, and we take that until we get back to the 50% of the equilibrium, preferably a discount. Do you see how we frame the bias and the narrative when we use these tools, right? Always look at the liquidity pool, and if there is a price array above it, like a fair value gap, expect us to sweep the liquidity pool into the price array, preferably when the price array, right, is OTE of the external range, because this is internal, this high. You see from this high to this low, right? When we move down, it's a retracement. We care about this range from here to here, right? Now, the OTE, when it's lining up with the sweep on internal range liquidity, that is, I love that, especially into a price array, even better, added confluence, right? This is how you start to frame your bias and your setups. So I want to see the Euro USD trade higher into this fair value gap and rebalance it into the OTE, and I want to see if it offers lower prices from there, right? Because essentially I want to take out the buy stops here, trade into this fair value gap, and I want to see the pairing of smart money's short orders with these buy stops that reside above this high. That's all it is, right? There's buyers up here, so trade above them, trigger them in on their buys, and then sell to the buyer, right? So if we go to the intraday level now, if we go to the intraday level, we saw that we offered higher prices, but we expected this as well, right? Why did we expect that? Because we took out, right? Remember on the DXY, what did we see on the DXY? Remember the last weekly commentary, we had this price action, yeah? We had this high, and then we took out this low, right? With this low, traded lower than this low. And I said that at the start of the weekly commentary 13, I said there's been an hourly market structure shift, so it's likely we're going to trade lower with the DXY. Same with the Euro, right? But with the context of the Euro, what did we have? We had that purge on external liquidity, and then what do we expect when we took that external liquidity? We want to trade back in within the higher time frame internal range before offering lower prices. So by trading back into the internal range, we expected the higher prices, right? This to get rebalanced and these highs, these clean highs to get traded above, which we did. So we have Monday, Tuesday, Wednesday, Thursday, and Friday. And you see that Thursday was a mighty move around 150 pips. I think it's 143 pips. Let's check it. 142 pips, around that, give or take. Yeah. So you see that Monday created the low of the week and Thursday created the high of the week. In the free channel, did I not say this? And I gave this away for free, but the guys, they won't appreciate it and they won't understand it. You guys are getting the handheld treatment of me saying this. The bullish week, right? We expect the low of the week to be placed in early and the high of the week made at the end of the week. Why? Because that's how a bullish candle forms. It makes a low quickly and it makes the high towards the when the time is running out for the candle. Let's say to the 15-minute of the 15-minute candle, right? Let's say we break the 15-minute candle down into 5 3-minute candles. The first two 3-minute candles might trade lower, and then the next, you know, the next uh the next two candles trade higher or make the high, and the last candle might just trade back within the 15-minute range and make the high, like here, right? Just make the top end of the wick. Each candle has the same anatomy and they'll form the same way. So this weekly candle looks like this. This weekly candle looks like this. Let me do it like this actually. Don't worry about the color. See how this low matches up with this low? Then we have the expansion all the way to the top, this high with here, and then Friday trades back down and closes. That is essentially what I told the free chat today. And that's how we anticipate a bullish week to form. That candle over and over again. It might not always look the same. And we don't care with the closes. We care about the expansion because essentially what we want to trade as day traders is the expansionary move, right? Where is that candle reaching into? Is it rebalance? What area is it looking to rebalance, or what area is it looking to sweep the liquidity on? And just as a tip, right, for your higher time frame analysis, first look for areas that need to be rebalanced. If there's nothing that needs to be rebalanced, and because why I say that is because imbalances are very easy to spot. So if there's no imbalance that we're clearly reaching into, then look for the liquidity pool that we're reaching into. Because if it's not rebalancing imbalance, it's reaching into liquidity. What liquidity pool is it reaching into? What is it respecting and what is it clearly attacking? And what's next to attack? Outline that liquidity pool, assuming that your liquidity pool is correct and we are indeed attacking it. Get in line intraday to take out that liquidity pool. If it's an area of imbalance, the same thing applies. Get in line to rebalance that area of imbalance, which is what we've been doing on the euro, right? And the DXY. We want to rebalance that monthly fair value gap. So we're getting bearish on the dollar and bullish on euro because we want to balance that fair value gap on the euro, right? Now, you see when we traded higher, right? You see this retracement. How did we know this retracement will come here? Well, how did I know this retracement is likely to occur here? Let's go on a 4 hour because I think it's clear on a 4 hour. When there is a retracement, for the people that have done the studying, where do we expect the retracement to come to of the range? I'll let you answer it internally. The 50% of the range. So if we go to the lowest point here and we go to the highest point here, looks like magic, doesn't it? What was it lining up with as well? The 50% of the range. We had this 4 hour imbalance and we traded underneath this low, right? To the 50% of the entire range. So it was very likely to trade within this fair value gap. Because when we see, right, and this is why it's very important to be very conscious of the swing highs and swing lows. Because when this swing low is made and this swing high is made, it's clear that, okay, we made a low and a high. It's likely we're offering a level of retracement. Where is the retracement likely to end so that I can hunt again? First thing you look at is the 50% of the range. Now, is there a price array that exists at the 50%? Yes, there is a fair value gap. So what do we do with the fair value gap? We trade into it and we expect to find a rejection and we expect it to act as a support level. And that's what we got. So you could have started hunting here for higher prices and get involved. Now, always be aware of the 50% of the range because that's where we expect the price range to rebalance to. When there is a retracement offered, usually is to rebalance the range of the swing low to the swing high. So we expect the 50% to be traded to at the minimum. So now if we go to the intraday, I want to show you guys a few things that occurred in the marketplace. Wait, I don't think that this is Friday, Thursday, Wednesday, Tuesday. Yeah, this is my bad. How do I go back? just add that line again, sorry. Now Monday was what? Monday was a small range day, which I like. Now, with Monday, what I wanted to see was this. I mean, for Tuesday. So you see how Monday left this fair value gap, right? Tuesday, well, we expected that week to be bullish and trade into the fair value gap for the Euro USD, right? Because we were bearish on DXY. I wanted to see it from the midnight, right? So when we're bullish, right, for the Euro or any pair, when you're bullish, you want to see a level of retracement at the midnight. At the midnight price for the New York time, UTC -4, we want to see a retracement lower than the midnight. So using this logic, I want us to retrace into this fair value gap, and I would have been a buyer here, right? However, it didn't do that, and it took off, right? But what did it leave? It left this candle. Now let's go on to a 5-minute chart. So what is this? Is this a mitigation block or is this a breaker block? Pay attention to the lows. Yeah, it's a breaker block because there's a high, lower low, higher high. Mitigation wouldn't have made this lower low. Mitigation would have done the higher low and just went higher. But the breaker does what? Makes the lower low a sweep on the liquidity and it trades higher. Now, when I saw this, right, I'm very interested into the market. And I actually did catch this trade, which I can show you for the MT4. I'll show you on the funding. I'll add a screenshot after I make this video of the trade, right? I'll show you the open and the close and the time. It's the 17th of May. You will see that it will say the 17th of May on the times as well, yeah? I saw this fair value gap. Now, removing this, this is what I call, well, not what I call, what ICT calls the institutional order flow entry drill, IOFED. And why is it an institutional order flow entry drill? Because it sweeps liquidity and rebalances imbalance, which is the job of the algorithm. And as we're hitting both functions of the algorithm in one go, that is institutional order flow entry drill. That's how I, that's how I, you know, deciphered it. He hasn't said really why, but yeah. Now you see these two candles, right? That's equivalent to double bottoms. They're too clean. The bottoms of these candles are too clean, and it's leaving this fair value gap open. So what I like to see is the dip into this fair value gap and go higher. But what? Wait, 1 second. What does this fair value gap line up with on the left? What did I just take off? This breaker block, right? So if we outline the whole thing, we will get the breaker block and the fair value gap. That is what was screaming to me to take the trade. I want you guys to start pairing all of your price arrays with fair value gaps. Mitigation block with fair value gap, breaker block with fair value gap, order block with fair value gap. It's hard to get rejection block with fair value gap, right? Because it's the wick of the candle. But the mitigation, breaker block, order block, I want you guys to start pairing these with fair value gap, because fair value gap is likely to get rebalanced, plus trading into the price array is a very high probability setup. Add in the factor of time of day, it's even better. Now, this, right, when you see this fair value gap paired with the price array, this is, in my opinion, the highest quality setup that you can take, given that it's in the time of day and in line with your bias. And you see that the move it offered after was a New York session, right? So look, this was an hour before the New York session, right? And this happened prior. I didn't capitalize on the whole entire move. I think I must have got out around here. I didn't need to capitalize on the whole move regardless. And my low was just below this low here, or was above, or was here, I think. One of these two. I think it was here and I trailed it to here, just to remove the risk of the trade. Now, if we go back to Thursday, in the chat, right? So this is Thursday right here. This is going to show you the fair value gap with the aspect of time. If I go to the 15-minute, all right, cool. Let's remove this so that we can focus on this one. Now, I'm going to add some vertical lines to show the kill zone, right? So here to here is the New York open kill zone. We see that this fair value gap is left prior to the kill zone. And what happens? We trade into the fair value gap, right? And then we move higher. Again, it's an institutional order flow entry drill. Now let me remove these so that we can see the wicks, right? You see how, as well, at the start of the session, what is this? Let's go on a 5-minute. At the start of the session, what did I tell you in the market making series? Not the series, the video that I made for the first lesson of chapter 1, chapter 3. I said that at the start of the session, there's always, a severe influx of orders, buyers and sellers. And what does that do to the hose pipe, right? The hose pipe's not open yet. It's coming to the start of the session. So the water is being held, right? The market's being held. Consolidation is being held. And then what happens when you release the water? There's that crazy burst of water before the natural flow occurs again, right? I like to use this analogy for the accumulation, manipulation, distribution power of 3 that occurs at the start of sessions. Accumulate the orders is the water and it's being held. The manipulation is that burst once the orders are released and that hose pipe is released. There's that crazy burst of water, and then the distribution is just the natural flow. This one was, compared to the previous one, is the better example to use because it's in line with the time aspect. The other one has something that this one doesn't have though, which is the fair value gap price with the price array. So they're both good examples to show you because they're both, you know, unique in their own way. The first example with the fair value gap and the breaker block, and this one with the fair value gap with the respect to the time of the New York open kill zone, right? And then we trade higher. So that's pretty much the end of this weekly commentary. I want you guys to be aware of specifically the open of the sessions, because the open of the sessions, right, you don't look to just enter straight away. You look to hunt at the open of these sessions. With reference to the market making video, if you're looking to be a buyer, which I was on the euro, right, what do you wait for? You wait to be taken to your seller, which resides below the what? This low. This low, there's sellers with sell stops. So when they're selling, you buy it from them. That's all you do. On the opening of the market, wait for the market, wait for this market, right, to deliver you to the person you want to buy from, which is under the lows, preferably into a price array, which is a fair value gap. Buy off of them. Vice versa, for a bearish scenario, you want to go to your seller and buy you want to go to your buyers and sell off of them, right? So that's going to be the end of this weekly commentary. The takeaways is the way I derive my higher time frame bias, right? Remember that internal dialogue I was telling you guys I have. There's a monthly fair value gap. When I look inside of it, there's a weekly. Now within the whole monthly fair value gap, where do we expect to trade to within the fair value gap? Well, usually the 50% of it. So when we go into the daily, what do we see within the 50% of it? The daily order block. This is how we start to frame a narrative. And then adding onto that was what? The macro of the US. They want to hike rates in June. So it's the end of May. Before the hike, what are you going to let smart money do? You're going to let smart money buy at a discount price, which is within the fair value gap. So it makes sense to trade into there before June starts a new quarter and the hike kicks in. It's about building a narrative, yeah? For the newer guys, I warn you guys, right? Don't binge watch the content. There's like 20 hours of content. I don't want you guys to binge watch it because you're not going to learn that way. You see, the guys that were with me at the start of this mentorship, they've been with me for like 3 months now. They had the added benefit of being able to digest the content as it's been released. You guys have the burden of playing catch up, which isn't so bad because the videos are saved and there's no rush to catch up. Take your time with it. Make sure you're digesting the content as well as you can, right? Whenever you get time, go back to previous videos. Make yourself familiar with all the content. You don't want to be strong on chapter 2 and weak at chapter 1. You want to be strong on chapter 1 and strong at chapter 2. And when chapter 3 finishes, you want to be strong on chapter 3. You don't want to have a weak spot. Just like with any other aspect of your life, you don't want to have an imbalance on you're good at one thing and good at another thing, because the way you're going to see success from this mentorship is when you're being able to blend all the chapters together. I'm going to help you with blending it because what chapter 3 essentially is blending high time frame bias with a price array with the aspect of time to get in line with your bias basically. But you guys, right, when you know that you guys are doing better is when you can look at my chart, and when I tell you I'm going to say something or I'm going to outline something, you're saying it and you're outlining it before I'm doing it. That's when you know that you're on your way, you know, and you're likely to become consistent and you're progressing. So just bear that in mind. So I'll see you guys on Tuesday with the next video. So until then, take care of yourselves.